Good morning, everyone. If I could ask you to take your seats, even the bright young folks sucking coffee at the back of the room, it would be nice if you took your seats. Welcome to a provocative, we hope, and important morning, and also one with a slightly different format than our usual. I'm very proud to welcome today Professor Sheila Bair, Senator Sherrod Brown, Governor Jon Huntsman, and our own and MIT's Simon Johnson to discuss the problem or the potential problem of too big to fail financial institutions. It's an early morning crowd, and we're going to do this in a, as I said, a slightly unusual format. The idea is that as our distinguished guests take their seats, that Simon will be conducting a conversation with the three folks who were good enough to join us today. And it's something of a, to use the time-honored phrase from TV's Bachelor, a journey on how these three people of different backgrounds, different experiences, all extremely distinguished, I'll let Simon give their brief bios, came to share a common concern. And I want to stress that just because they share a common concern doesn't mean everyone in the audience or everyone in the Institute shares that concern. But it does mean that it is worthy of note that three such different people of distinguished public service have come together on a common issue. And I think that is worthy of us hearing out. There are several fundamental questions, which we hope they will address at least in part. We sit here in the US and look at one of the most diverse, deepest, least concentrated banking systems in the world, coming from the UK, where I served at the Bank of England the last few years. You have essentially 5 big banks running the entire financial system. It's a very different kind of experience, and yet there is good reason for us to be concerned about the regulatory implications and the economic stability engendered by institutions that are very large. Financial institutions are very large. At the same time, there were a number of people, and myself among them, I must admit, even though I'm generally a strong regulation person, who a dozen years ago were saying, well, hell, the savings and loan crisis came because we had all these rinky-dink little institutions that we couldn't keep track of and they didn't know how to behave. Maybe it's like the old Mark Twain saying, put all your eggs in one basket and watch that basket. So not to say that's right, but it's an interesting question. And when we look across countries, as is of course part of the mandate here at the Peterson Institute, we look at a Switzerland where 2 very large banks seem to have been a very real problem, but we look at a Canada where you seems to have 4 very large banks and have gotten through very smoothly. So the issue is not self-evident. There are reasons in economic terms, it seems, why there is a natural logic for at least some institutions to become quite large. On the other hand, there is an academic literature that does not have not found as convincingly, obviously, evidence of economies of scale or scope as some people might have expected. So there's a lot to play for, but particularly with this distinguished group of policymakers and influential people, we'd like to focus on the practicalities, I think, I hope. If too big to fail is a problem, what does that mean for what kinds of institutions? How do you enforce that? What are the costs and benefits? Can you get around that by putting on strict size limits? Is it capital requirements? Is it different forms of supervision? Is it you really have to change the law? Is it credible to change the law in a way that will automatically work? Anyway, thank you all for joining us, and now for the first 40 minutes or so, I'll turn it over to Simon for our conversation.
Thank you very much, Adam. Thanks for the opportunity to have this discussion at the Peterson Institute, and thanks everyone for coming. I think, in my view, we're going to have a fascinating and perhaps somewhat unique discussion this morning, although hopefully the first of many. Let me just very briefly introduce our 3 panelists and put the first opening question to them. We've tried to mix everything up for you today in terms of where they sit as you look at them. This is supposed to be a discussion across the political spectrum with many unexpected points perhaps emerging. On your left, is Sheila Bair, former chair of the FDIC and the author of an excellent book, Bull by the Horns, that I hardly recommend for anyone concerned about the financial sector and what has happened with regard to our biggest banks in this country. Next to her, in the middle, is Jon Huntsman, a former governor of Utah, former ambassador, U.S. ambassador to China and Singapore, and also a very experienced executive in the non-financial sector, including with Huntsman Corporation. And on your extreme right is Senator Sherrod Brown, the senator from Ohio, a member of the Senate Banking and Finance Committees, and a senator who introduced in 2010 an amendment to Dodd-Frank, an amendment that didn't ultimately succeed, but would have made our largest banks smaller and less leveraged. And he continues to very effectively press the case for making our financial system safer and addressing the issue of big banks. But let me begin with the first question, and I'll start with Sheila and then take it to John and Sherrod. There is a view that is expressed more or less in public by some Wall Street executives and people who work with them, that there is actually no such thing as too big to fail. That the too big to fail either didn't exist or it's been addressed, and it's somewhat a figment of the statistical imagination. So let's start by understanding your positions. Is there such a thing as too big to fail? How should we think about that? Right. Sheila.
So there is something called too big to fail. Why did we do these bailouts if there weren't institutions that the government decided that if they failed in the normal bankruptcy process, it would hurt the rest of the economy? So clearly we did have too big to fail. I think we still do. I don't think we get rid of it until the market's convinced that this is over, that these big institutions no longer have a put on the government. If they get in trouble, the creditors and the shareholders are going to be taking the losses, not taxpayers will not have to put their money at risk. I mean, certainly you could see it, real tangible evidence of too big to fail as the crisis accelerated and people became increasingly concerned about the safety of the banking sector. We saw uninsured deposits fly out of community banks, frankly, and go to B of A, JP Morgan Chase, the banks that were viewed as too big to fail. So I don't think we would have seen that dynamic if the market itself and the public itself wasn't viewing some of these institutions as institutions the government would not let fail. And this creates an inherent competitive disparity. That's why their funding costs tend to be lower because, again, folks think that if they've got especially their debt, their unsecured debt, that there's a put on the government and they're not going to have to take losses. So it needs to, it very much exists. It existed prior to crisis. It encourages risk-taking. If you're an institution and you think with a lot of leverage, you can have really big returns for a time when times are good, and when the losses come, you're going to put that on the government. You're going to go out there and take a lot of risks. That's just basic economic incentives. So not only does it create a competitive disparities and puts taxpayers unfairly at risk, but it skews risk-taking, it skews investment dollars to large institutions and gives them positive incentives to take risks that they would not otherwise undertake.
Okay, thank you, Sheila. John.
Well, I think you have to look at the numbers. Again, I come at this not as a regulator, not as a member of the Senate, but as someone with a varied background, and I see it through the lens of whether or not what we are doing in the financial sector is actually getting capital to the innovators and the entrepreneurs who keep the machinery running. And as we're getting back on our feet economically, we ought to see this period as a moment to simplify, to get risk out of the system. And when you've got 6 institutions, the combination of which, at least in assets, are equal to 63, 64% of our GDP, not a one of them can afford to go under because of the catastrophic effect it would have on our own economy. That then becomes something that is too big to fail. Does that promote increased risk-taking within in terms of maybe trading activities or the kinds of financial instruments that are used? You'd have to say probably. Is there a subsidy that goes along with that view that they are too big to fail when they get a notch or two on the credit scale above what they otherwise might get, and 80 basis points to 100 basis points advantage in terms of cost of capital? All of that plays into the mix when you look at the health and competitiveness of something as important to our economy as our financial system. So is this a time to look at banks that, to my mind, are too big to fail, what it is doing to overall competitiveness, if in fact it is getting capital out to our innovators and creative types in ways that would allow us to rebuild ourselves during a time of, I think, continued economic vulnerability? Yeah, I think all the above is true.
Okay, thank you. Sherrod.
Only add a couple of points. I think both Sheila and John are right about that the markets have the markets, the 70, 80, 90 basis points advantage that the 6 banks have. Bloomberg had a recent story, upwards of $80 billion in additional profits as a result of the market's reaction to too big to fail. Tom Honig was in my office one day a year or so ago, talking about this and sort of the implicit subsidies. And one of the things he thinks it leads to is that this bias that we seem to have as a economy now, as a nation, we emphasizing financial services over manufacturing, Governor, which your family's been involved in. You look back, it's not just, you look back on financial services 15, 20 years ago, these 6 largest banks made up, their combined assets were something like 18% of GDP. Today they're 62, 63, 64% of GDP. You look at what's happened with the relative position of manufacturing and financial services. 30 years ago, different measurement as a percent of GDP, obviously, it's revenues, but banking was about 10% of GDP 30 years ago. Financial services was about 10% of our GDP in terms of revenues, and manufacturing is about 25%. And that's pretty much flipped, that manufacturing is now only about 11 or 12%, maybe slightly less than that, and financial services is in mid-20s. And I mean, look where that got us in terms of ticket to the middle class for so many working families where manufacturing was their opportunity. And financial services is a great job creator and all of that, but nothing compared to what manufacturing was. And wealth is created by making it or growing it or mining it, and we aren't making enough. We aren't making enough things now, and part of the reason I think is the implicit subsidies and the bias in our economic/political system because of financial services. And I would add one other point, and that's not just the economic power that the financial service and that these 6 large banks have. It's really the political power they wield. And Sheila's just done yeoman's work as a regulator. I wish there were a lot more of her in the government today, and yesterday too, for that matter, that really understood the economic power of, or the political power of the large banks, and could equalize a little better.
Thank you. And I would just like to recognize Tom Honig, who's in the second row of the audience, and recommend to all of you the numbers that he and his colleagues have calculated, the FDIC, with regard to the size of banks, comparing across countries, and also the right way to think about capital and capital level in those banks. We might come back to that in the Q&A. So the 3 of you, I think, have given us completely complementary, very consistent views with slightly different emphasis or words, but I think with one picture. We're concerned about what has happened to our financial system and the way in which these very large banks have become so powerful and what that does to the real economy. So the next question then is, what should we do about it? At least at a broad level, in terms of policy and thinking about how to approach this issue. And we'll talk about some of the details later, and we can have questions about more of those details, no doubt. Broadly, and let me start this round with Jon Huntsman, what is your broad perspective in terms of sensible policy that would move us responsibly in the right direction on these issues?
Well, look where we are and what has been tried. So after the catastrophic years, 07 to 10, we get out of this situation driven by fear, driven by the consumers who are no doubt making the arguments with their members of Congress that it can't continue. We have Dodd-Frank. And despite their, I think, sincere attempts, I mean, too big to fail is even written in the very preamble of Dodd-Frank, 16 titles, 900 pages, 3,000 pages of proposed regulatory fixes. Based on one estimate, it would take 2,200,000 hours per year in order to live up and comply with those, and we're not done yet. So the answer is kind of moving out in real time, but I fear it's going to sidetrack our financial model in ways that place too much of a burden on the local and regional banks, who simply can't step up and pay for and embrace the kind of regulatory weight that Dodd-Frank is calling for. I would say at some point we're going to have to measure the relative level of risk that these banks give, and then how you address it, how you counterbalance the implicit subsidy that, that is being covered by the taxpayers. My guess is that you either look at the size of the banks based upon the percentage of GDP and keep them within a certain size. As Sherrod mentioned, 20 years ago or so, what was Goldman Sachs in those days? Maybe $200 billion in sales, today $1 trillion. Are we better off or worse off as a result of the growth? I don't know, but that ought to be looked at. I think it's important to analyze and share with the American people the risk that we are carrying today. I don't think that's fully understood. But I believe with that, we ought to work on taking the subsidy out of the system. That ought to be, I think, our first order of business. I'm not sure how that is done. Sheila would have a much better feel for that, but my guess is, imposing something like a fee on banks that until they right-size themselves to a size where they're not too big to fail, they have to pay into some sort of account that would ameliorate to some extent the risk that the taxpayers are carrying. There are other discussions, maybe looking at the way the FDIC measures their own level of risk by way of looking at maybe asking for more in the way you measure and price risk in your premiums. But all of this ought to be part of the work we do in the next year in, first and foremost, sizing up the risk for the American people. Second of all, looking at realistic ways to correct that. It's not an easy call, and I think the whole discussion is up against some entrenched interests that will make it a very, very difficult thing to do. But I can tell you this, having had more than my share of town hall meetings in early primary states, but we won't get into that part. There is a real connection by people. And again, on both sides of the political aisle, they get the importance of this issue, and I think they understand it through the prism of their local community banks, with whom many of them have carried on very personal relationships. And when they see that model threatened by an overhang of bureaucracy and larger banks that have some implicit backstop by the American people, access to discounted capital, I think that becomes very worrisome for them. And they get the part about how this may run counter to our long-term competitive interests.
Okay. Well, Sheila, let me take up the point of insurance and paying for insurance. And you say in your book, I believe, clearly and many times, that when we have insured deposits, which we've had since the 1930s, there's a premium that you have to pay for that, and there's also a lot of regulation and oversight that comes with that. Now, that's for the part of the financial system which has retail deposits. Should we think about some sort of insurance fee or premium for the banks, the big banks more broadly, not with a view perhaps to making that a permanent arrangement, but to put pressure on them, as the governor said, to become smaller and to right-size themselves?
Well, we actually push that as part of Dodd-Frank. So for the deposit insurance premiums are risk adjusted, and so you do pay more if you have a riskier profile. But deposit insurance premiums also are there to backstop deposits. So I don't think we want a new insurance system for other liabilities. We clearly don't want that. But I think it's completely appropriate to assess a fee on these large financial institutions. And a lot of the high-risk activity occurs outside of the insured bank, not inside. So to have a fee that's based on how risk they are, that requires them to internalize the external costs that they impose to the rest of us and the subsidy advantage they have over smaller institutions. So we made that case in the House. We got a $150 billion fund in the House. It went to the Senate. And unfortunately, I ran into the same problem that you ran in with yours in terms of resistance from the Treasury Department. And so it was dropped in the Senate. But I think that would have been a huge boon to give the FDIC the authority to do a risk-adjusted fee, not to guarantee liabilities, to provide working capital if you did have to resolve one of these very large institutions, and again, make them internalize the risks that they pose to the system. So I still think that's a good idea, and it could definitely help address the skewing of investment capital and level the playing field between larger and smaller institutions.
And Sherrod, on the issue of size, no one has been as outspoken and forceful and as effective as you on really making the debate more about size and correcting size. Could we do it with a fee? Do we need a size cap, a restriction of some kind? What's your perspective on that?
We've advocated the restrictions on size, obviously, but there are several kind of avenues we're approaching, and we're seeing and John and I were talking about this a little bit before. We're seeing this increased interest, I think in large part because the public, I like what you said about the public seeing it through the prism of community banks, and those are the people they tend to know, and certainly don't blame for the financial crisis, rightly so. But I think that what's happened is members of Congress, political pundits, media people, and certainly people like a lot of you that think about this have look at this a good bit differently from 3 or 4 years ago. Our bill to cap non-deposit liability, our Brown-Coffin amendment got 34 votes. 3 Republicans voted for it. One of them is not there now, so we're down to 2, except we're not, because we have, we're talking, Graham Steele in our office, who many of you know, we've been talking to literally 10 Republican senators who have interests in taking one of these avenues. It may be, it may be, how do we do capital standards and tier them so that community banks get probably some relief, and mid-sized regional banks, some like in my state, Huntington or Key or Fifth Third would be sort of a second tier, and then the largest banks would have a higher, obviously a higher level of capital, and addressing the issue of the quality of capital. The quality of capital for community banks is more liquid and more solid, if that's not a real technical term, but than what Wall Street uses for what the big six use for their quality of their capital. And so I think we look at that, and then I think we look at the whole issue of restricting the amount of debt that a single company could take on relative to the economy. So I don't think we restrict ourselves to one of these paths. And Senator Vitter's major interest seems to be on capital standards. I'm fairly agnostic on preference of the two. Capital standards are actually limiting the restricting the amount of debt that a single financial enterprise can hold or take on. But I think we approach each of these because I think it's a question of building support in the Senate and in the House. And we are today at a place that I wouldn't have imagined a year ago we would be, because the public and the policymakers are starting to figure this out and start to pay more attention to it. I think partly because of the fear of what really could happen as these banks have gotten larger and larger.
Well, that's my next question, which is about the politics. So as both Governor Huntsman said and Senator Brown said, when you talk to people and you try to get their votes, at some level they really understand that the damage that's been done by Wall Street, by very large financial institutions, is enormous, and it's affected every community. And yet, perhaps, hopefully these ideas are now starting to get traction in Washington. It's been a long time. The crisis manifested itself in 2007, 2008 was terrible, 2009 was perhaps worse, and the legislation passed in 2010. So let me ask each of you, I'll start with Sheila on this round. Why have the politics been so slow to respond to what is not, in my view, some sort of dangerous populism, but actually convergence of sensible policy thinking and what people outside Washington want to happen? Why the slow reaction?
Well, financial services just got too big. They got too big as part of the economy. They got too big as part of the political system. And they, day in and day out, large financial institutions have a lot of lobbyists and law firms and things here. And, I don't fault them for that. They're in the business of making money, and so they, like everybody else, comes to Washington to try to advocate their case. But it's lopsided. There's the counter pressure, that populist appeal, that what I think the vast majority of the population really wants to happen, meaningful reform, doesn't happen because you have this lobbying pressure. I think we need more leadership from the administration too. I don't think we got the leadership that we needed during Dodd-Frank, and that needs to be part of the solution. But we're still not, that I see, getting much leadership from the administration on these issues. So the capture is, a lot of people say, is bipartisan, and it's not. When I say capture, I'm talking about cognitive capture. It's not so much corruption. It's just listening too much to large financial institutions, the people who represent them, and not enough to the people out on Main Street who want this fixed.
Sherrod, and then
I think she's exactly right, and the Brown-Coffin amendment got 3 votes out of the banking committee, including mine. That tells you something. I think Sheila's right. I don't think it's the corruption of the system, but it's not really the corruption of individual senators, and that sounds a little self-serving as an individual senator, but I really do think it's so much, in many ways this town sings with an upper class accent, and in many ways, what we hear every day, we hear more from just, until recently, until people like Simon and have stepped up, and people like Torillo and Richard Fisher, and people who do financial regulation of some sort for a living, most of what we heard from economists, from people who are in the know, who are people that were supposed to the serious, mostly men, unfortunately in this town on these kinds of issues, and in New York, that's kind of what we hear all the time. So it's not so much corruption as it is that's who we listen to, unfortunately, and and that's the importance of some of you in this audience, including the three sitting next to me, who have helped to educate people like me. I got on the banking committee without any real banking background, and I read 13 Bankers, and it's as good a case as I've ever read on what we do about restricting the amount of debt and what we need to do, and the courage that Governor Huntsman's shown on this issue, when it's not necessarily been popular in some parts of his party, and what Sheila's done. I will always sing her praises, and as I said, wish there were more of her. But I think the politics has changed, but I think it's not nearly there yet. I think if we did that amendment freestanding on the Senate floor again, we'd get 45 votes. I think that a number of members, not a majority, but a number of members of the Banking Committee have said they either made a mistake or they would vote our way this time. I think that, when Senator Grassley and I sent the letter to the Attorney General asking him what exactly were they, we use the term, because everybody plays off the same terms, we use the term too big to jail, because they wouldn't, I know that wasn't really very clever, but they wouldn't want us to. Did you come up with that term, Grant? That's a really clever term, excuse me. But, they were not, it didn't look like they were as willing to prosecute as they should have been, because what would that do to the financial markets, and what would that do when one of these institutions is so large that it could ripple through the financial system and cause damage to the economy? I mean, it's evidence, and it's also anecdotal when we're seeing these kinds of stories and these kinds of things happen that don't allow the justice system and the political system to work the way that they should. And I mean, that's nothing new. But again, I'm hopeful, because I've seen much more progress in the last 12 or 18 months than I've thought possible at this point.
Well, I think it was, I don't know who coined the phrase "too big to jail," but I know Lanny Brewer, who was at that point a senior official in the Department of Justice, said in public that it was difficult to bring criminal prosecutions against some large financial institutions for fear of the consequences. And that struck me as being fundamentally at odds with the principles of both justice in general, and even how the Department of Justice justifies its budget, which starts with the words from Thomas Jefferson about how everybody needs to be equal before the law. But on the politics, John, do you agree, is it changing, or is it changing in a meaningful way? I mean, yes, people are angry, people are upset, perhaps more people understand these issues, but is there a movement, or is there a Teddy Roosevelt type moment when there's across the political spectrum, people agree on an issue enough to actually, for that to shape elections and for that to change policy?
I think we'll get to that point, and it may take another election cycle for us to get there. It's got to rise, it's got to resonate, it has to find its proper cue in the hierarchy of issues. I mean, it can't be number 10, it's got to be number 3 or 4 in order for people really to start paying attention. But it's been fired by passion and emotion, Tea Party, Occupy Wall Street. Where do they come to? They come together on this issue, and they come together on this issue because they sense that the market is rigged against them, that we don't have equal outcomes, that we don't have equal opportunity, we don't have a level playing field. And I think that stirs a lot of passion out there when they feel the system is rigged against them. And that's kind of where we find ourselves. So you take the passion and emotion that really, I think, was part of firing the early Tea Party movement, and certainly Occupy Wall Street, and that then sort of settles out into the fact-finding. And that's where I feel we are today. How do you take the passion and emotion around a very legitimate issue and begin then to sort it out based on the facts, the risks, the fixes, and the real policy solutions like Sherrod and others are brave enough to tackle? And that will probably take a little bit of time. But I'm actually surprised, Simon, that this has moved as quickly as it has. You don't have to go back too far to see the people in the streets talking about this issue. The response to Dodd-Frank, You know, as the old Yiddish saying goes, you know, man plans and God laughs. And, you know, the aftermath, it was a real concern. I felt it on the stump during the last presidential cycle. I talked about it in our town hall meetings, and I could feel there was a very deep and meaningful connection with this issue. I think it's going someplace. It has legs because it's based on a legitimate imbalance in our system. And people feel that something as important as our financial sector is not as healthy today as it should be. It is the sword of Damocles that continues to hang over us right now. And it needs to be addressed.
Okay, that leads to my one more round of questions before we go back to Adam and the Q&A. Let me start with Sherrod, then John, then Sheila. So we've talked about the general problem, and you've all expressed broad ideas about what should be done, and the hope, at least, that the political moment is coming. But this year, the 100th anniversary of the founding of the Federal Reserve, it strikes me and some others that the Fed, under Dodd-Frank, acquired more powers. There is, of course, also the Financial Stability Oversight Council, which is chaired by the Treasury. But again, the Fed is very important in that structure. What should we be pressing the Federal Reserve, the Board of Governors level, for example, what should we be pressing them to do in terms of either policy actions or studying, understanding, measuring the scale of the problem? Is there something the Fed can take the lead on in our existing framework while we wait for Congress to act or wait for different people to be elected? Can the Fed take this on? Should the Fed take this on? Is the Fed undermining its broader legitimacy if it continues to refuse to take this on? Sherrod.
I don't know the answer to that. I would start with a couple of comments. I asked Jack Lew in the Finance Committee hearings on his nomination about his role at FSOC and what he should be doing at Treasury, and was less than overwhelmed by his answer on even recognizing the advantage, the implicit subsidies that the largest banks get. So I think we have a ways to go there. I think that the Fed probably is not in a much better position than that, but I think it's partly up to us to give them the evidence. One of the things that we're working on with Senator Vitter is we passed a bill through the Senate, the House, somebody stopped in the House, but then we wrote a letter to GAO asking for a study, which will take about a year, we think, but we hope we can accelerate parts of it to really quantify the advantages that they get in these sort of implicit subsidies. That will help us. So I think I think it's really continued pressure from those of us in the Senate and the House that care about this on the Fed, on the Secretary of Treasury. I'm very concerned about, Dennis and I were talking about this, about whom the President or the Secretary of the Treasury, whoever actually does the hire there for the number two person, that it's not somebody from Wall Street, that it's somebody with a different perspective. Kind of whispering in Secretary Lew's ear. I don't question Secretary Lew's motives at all. I just think that we've seen that kind of bias in administrations, surely of both parties. But I also, I think partly when I heard Governor Huntsman say, we're sort of saying the same thing about the speed in Washington terms and how fast this has moved. It really is. I think it's partly that when what happened with J.P. Morgan Chase and their loss of $6 or $7 billion, that with the CEO of considered one of the best CEOs in the country, perhaps of any business, certainly in the banking industry, that even the management at that institution didn't really understand what was going on. It really does play into the not just too big to fail, but too complicated to manage, too difficult to regulate. I mean, there's no, I'm a guy that believes, I wear in my lapel a depiction of a canary in a bird cage. It was given me at a Workers' Memorial Day rally 100 years ago when people working in coal mines, the story of the canary in the mine, they had no union to protect them and a government that cared enough to protect them. And I believe in regulation on health and safety and Medicare and all the other things, but I also understand that regulation on Wall Street alone doesn't do it. And when progressives see that it's got to be more than good regulations, partly their regulatory capture, partly it's just the difficulty and the opaqueness of it and the complexity of it. And if management of these firms can't figure out all the new financial instruments that are created by these brilliant young men and women coming to Wall Street, that managers of the CEOs can't understand it, how are the regulators paid so much less and usually much younger and less experienced going to understand it? So it's pretty clear it's got to be a broader attack on it than just the traditional way we did it, and I think more people are seeing that.
John, the Federal Reserve, should we put pressure on them to take this more seriously?
I guess there's a role to play. I think, given where Sherrod is and some of his colleagues, I think the Senate and Congress, that's probably the best place to at least begin to analyze and sort through the realistic options we have. I mean, going back to 1913, I mean, look at the Fed requirements, 1933, so on. So that didn't stop the catastrophe, but without doubt, there's a role to be played. But listen, this is playing out in real time, and we have to remember that the contagion effect of what is happening in the Eurozone. So if Greece can't get its act together, and the debt issue isn't properly addressed, and Spain, Portugal, Italy, and the rest of the major banking centers of Europe are then brought into this, then we start feeling the effects here, and of course the Chinese will feel the effects there. I mean, major banking centers in Asia. And that's why, given the risk that is still present in the global marketplace, this isn't just an academic discussion. I mean, this is playing out in real time. And therefore, I think as quickly as we can get to some assessment of risk, what that is, how you then begin to ameliorate that risk. Something along the lines of a living trust, maybe that should be our work for the next year, led by Sherrod and Senator Vitter and others. What is the risk, and what are the implications of an institution that goes bad in terms of the bankruptcy processes? Is the market able to absorb it? Not the implicit subsidies. This all needs to be broken down into fact that we can then base policy on. So I think the work for the next year is pretty clear. Take the evidence out there, shape it into information that is digestible, begin the heightening of awareness at all levels of society, and begin to think about realistic policies that can then be put forward. And that'll take you out a couple of years, but let's not forget, we're in a global marketplace that is still feeling some great uncertainty and real insecurity, both in Europe and to some degree in Asia. Certainly with Japan, the banking sector in Japan, and in China it's hard to know, but my guess is with commodity prices it will likely be impacted by their stimulus spending in 08 and 09. Nick Lordy is here, who knows it as well as anybody. A lot of overcapacity, a lot of manufacturing put up in recent years, roads to nowhere. You're probably going to end up with some non-performing loans at some point. It's hard to know what stress and strain that'll put on the Chinese banks. But we've got a lot playing out in the financial centers of the world that have immediate connections with our own institutions here at home. So it's a real issue.
Sheila, do you see any signs of the Federal Reserve taking this on in the short term, or are they just sitting back and waiting for events to unfold around them?
Right. Well, it doesn't seem so. And somewhat to my disappointment, Dodd-Frank did give the Fed and the FSOC and the Fed and the FDIC jointly really substantial powers to order restructuring of institutions that they deem cannot be resolved in bankruptcy without systemic impact, to order divestiture. The willingness to use those tools, I don't know. In the near term, I don't think that's there. And it may be that Congress, if that's the solution that we decide on, Congress will need to act again. But in the near term, there are a couple of very important things the Fed, working with the other banking regulators, can do that will at least make real progress on too big to fail. It won't solve it, but it will make real progress. One is get the capital rules in place and have a tough, effective, simple leverage ratio, the continued reliance on these risk-based measures as a primary means of gauging large bank capital adequacy, proven themselves to be inherently unreliable because they rely on conflicted bank management and inherently unreliable models to try to determine what the appropriate capital level is. So you need risk-based measures, but you also need a leverage ratio, a tough one. The Systemic Risk Council, which I chair, has argued for an 8% leverage ratio. Tom Honig, sitting here, is going to 10, and Tom, go for it. Be still my heart. But getting the capital levels up and with a simple, effective, enforceable measure that cannot be, is not so subject to gaming as these risk-based measures are, is really, really important. And that rule is out for comment now. That could be done in the fairly near term. The other thing that I think the Fed, working with the other bank regulators, could do would be to require at the holding company level that these large financial conglomerates issue a minimum amount of debt, long-term unsecured debt or equity. You and I, Simon, along with a few other academics, have filed a comment letter last summer arguing that they have a capital stack at least 30%, equal to at least 30% of tangible assets that would be available clearly for loss absorption if one of these institutions fails and has to be put into a bankruptcy or an FDIC-controlled bankruptcy process under Title II. That would make sure, I think the FDIC has come up with a viable strategy near term to resolve these very large financial conglomerates by taking control of the holding company. But you need to make sure there's enough loss absorption capacity at the holding company for that to work. And Ben Bernanke, Dan Chirillo, Marty Gruenberg, they've all spoken to the need to do this. I'm eager for those rules to come out. We filed our comment letter last July to get this in place, because this will make sure that they're much more resolvable if one of them does get into trouble, number one. But number two, it's going to create more market discipline and increase in funding costs, which I think is a good thing, not a bad thing, because this debt that they will be required to issue will clearly be available for loss absorption. I think bondholders looking to buy that debt are going to offer a lot of scrutiny of those banks and how safe they are before buying that debt and figuring out how much of an interest rate they want to be paid for it. So those are two big things in the near term that I think could go a long way to addressing too big to fail, which I hope the Fed acts on.
Okay, thank you very much. Turn it back over to Adam.
Yeah, well, first off, again, thank you to our guests who I think did a terrific job today, really. And again, thank you to Simon for putting this together. He's one of the few people who can bridge so many audiences and people. But we're also grateful to INET, the Institute for New Economic Thinking, which has supported this event and a number of outreach efforts that Simon and others are doing through the Institute. But as I've said, the part of the point of the Institute's convening power is we want people of all serious views, and this is very obviously an extremely serious view, to have the chance to put their best case forward, but to also have the chance to be challenged in an open fashion, and that their views are exposed not as shallow, they're serious views, but exposed to critical consideration. And that's why we're shifting it over to all of you. And putting aside my own personal sympathies, which are on the record on this issue, let me, if I could, just to get things started, pose a couple questions to our guests individually. First, Sheila, your last response to Simon I thought was great, talking about the nuances of the holding company and so on. But it sort of raises the broader issue. Today's event's about too big to fail. But we know that there were a bunch of other things that happened, right? We had AIG Financial Products, we had Household and Countrywide giving all kinds of mortgages, we had regulatory arbitrage across the countries. How far up do you think too big to fail is on the priority list? And more importantly, perhaps, Dodd-Frank, for all its good intent and perhaps virtues, is an incredibly complex document. If we're really worried about this, maybe we should be leaving aside the political possibility. I understand that, but just what we should be striving for. Maybe what we should be striving for is a utilities model, or something Paul Volcker dreams of, a very strict Glass-Steagall restoration. I mean, should we settle for this? Should we be going for something bigger? What's the priority here?
Well, I don't think you have to go so far, though I must say, I frequently hear from large banks when regulators push for higher capital standards or the Volcker rule, whatever, that old saw, well, that's going to hurt the economic recovery, that's going to constrain credit. And I do think they're kind of trying to have it both ways. So on one hand, they're saying, well, we're so big, if you increase our costs even a little bit, we're going to pull back lending, it's going to hurt the economy. So, well, that means they're too big. If they can't, we can't, require that they have an appropriate level of leverage and internal to cost of their operations, that they make them be viable without implied government subsidies. Then I think that's a problem. But I do believe Dodd-Frank gives the regulators the tools now to tease out those subsidies, to force better market discipline on these financial institutions, and to require a lot more transparency about their operations, which could lead to market-driven solutions to breakup. If you look at the analysis that has been done of share performance of these large institutions compared to the smaller ones, the ones that just take deposits and make loans, pretty much follow a traditional commercial banking model, the three mega banks, B of A, Citi, and JP Morgan Chase, have not performed well. I mean, Chase clearly is much better than B of A and Citi, but even Chase does not compare well to the better managed regional banks. And, you know, so why are they this big? It's not showing up in shareholder returns at all. And they don't, Mike Mayo did a recent analysis, and one of the things you can't even tell, so there's a movement right now with, that's being led by Trillium Management to get Citigroup, the Citigroup board, to come up with an analysis at least. Will show us, you know, you're trading a steep discount to your tangible book, which suggests you're worth more liquidated than you are as a going concern. So give us a breakup analysis. We'd like to see whether you're going to be worth more in pieces. But you can't do it now because the disclosure is so bad. So Citi and the rest of them, JP Morgan Chase is better. They won't show how they allocate capital and expenses. So they can say, oh, well, our investment banking unit's got this great ROE, you know, and commercial banking is doing well and all that. But you look at the returns on the holding company level, and they're not so good. So get the information out there. That's another thing that I think regulators could do that could help spur market-driven solutions to this. I don't think most of these guys are economically viable, make any sense at all if you can get rid of the government subsidies and then let the market downsize them. So that would be optimally the approach that I think would get us there the fastest. But again, the regulators need to get more information out there to the market, and they need to make them simplify their legal structures now. They've got these morass of legal entities. It's like a poison pill. You can't figure out, you want to break them up? Where do you start? You have 11,000 legal entities. How are you going to do that? So I think those are very positive actions that the regulators could take. They have the authority to do now that could help lead us to market-driven solutions as well.
Thank you for the very practical response. John, one of the reasons you have fans here, nothing partisan, is that we know you have an international background. You've talked trade with Fred Bergston, you've talked China with Nick Lardy, all our people. And it was very heartening for us in your last response to Simon for you to start talking about China, Japan, Euro area. So let me draw you out a bit more on that. One of the arguments that's made sometimes about pushing too big to fail as being problematic is the international side, in at least two senses. First, that, well, we can do this, we can regulate the three mega banks, whatever, but if the Germans, the Swiss, the British, the Japanese don't do the same, and we have open markets, all the counterparty risk is there. You know, so why does this matter? Does this make sense without somehow achieving an international standard? And the second piece of the international side, which again, I'd be interested in your response, is this in a sense a form of unilateral disarmament? Taking Sheila's point about shareholder returns, I'm not going to deny the facts on that, but there's usually an argument made that both for tax reasons and for financing reasons, it's good to have a national champion bank. It's good to have a bank at the cutting edge. You know, France has BNP Paribas, Germany has Deutsche Bank, UK has God knows what. You know, whatever it is, US can't do without that. So how do you think about those kinds of international arguments on the too big to fail issue?
Well, in many cases, the risk is far more severe in other countries than it is here, just given the size of certain banks as a percentage of GDP. And my guess is that the international banking community, although you know we do coordinate, and that may be part of the problem, we're all making the same mistake, and maybe we ought to kind of learn from those mistakes and move on a little differently. But we are still the heartbeat of, we write the lyrics for the international financial community. We are it, with the epicenter. And I think whatever is done here along the lines of assessing risk and dealing with the implied subsidy, and the regulatory steps that might be envisioned going forward, I think is likely going to impact the international banking community, right, because many are positioned in a way that we are, some even more severely. And given the fragile nature of the global economy and prospects for recovery, a few signs of life here and there, you can't fully regain your strength without rebuilding a robust and fair financial system. It has to be able to deliver seed corn to innovators and doers and entrepreneurs in ways that allow you to rebuild the machinery. And we're kind of right at a point, I think, a key inflection point in terms of our own recommitment to our own competitive base. I really do think the next few years could be very good for the United States, and I think the world will actually pay a lot of attention to how we begin to rebuild ourselves. But that has to start with a financial system that really does endeavor to get not only debt, but equity financing into the hands of those who are prepared to rebuild our economy, because the rest of the world is going to have to follow suit.
Thank you. Sherrod, Senator Brown, if I could. One issue which you were raised alone, not alone, but first on the panel, was you made some remarks about the size of the financial sector in our economy and relative to manufacturing, and that this was troubling to you in various ways. In this House and in most places where economists congregate, we viscerally hate that kind of talk. We viscerally hate the idea that there's any particular sector that needs to be lionized, whether it's financial services or manufacturing, that there's nothing special. And the countries that focused obsessively on manufacturing, for example, or focused on their rice farming, or focused on their banking system, go astray. Is there anything you want to say about that, contrary to what the economists in general think, that's just silly, or is there something particularly bad about finance, why it shouldn't be too big? How do you see that argument?
Interesting point. Let me add something to what John said about the size, our international situation. Then I'll try to answer your
Always
question.
glad to have you comment on international stuff here, Senator.
Okay.
That's fair.
Europe uses a different accounting standard systems to determine size of banks, and if we actually use their system for our banks, we'd have the 3 largest banks in the world. That's the first point I think to make. Second, is when I think J.P. Morgan was made the $20 billion loan to AT&T to take over T-Mobile. They divided that among 11 banks. I mean, it was so. It's not as if it's not as if you don't put a package of regional large banks. I mean, neither AT&T nor J.P. Morgan wanted the exposure of $20 billion on either firm's balance sheets ultimately. So that argument I don't think works. I mean, I hear it. It's sort of the first one they often say, you can't do that. It takes away our competitive position in the world. It really doesn't. It undermines it. It really doesn't do that at all. First of all, I'll start with my bias on your question. Much of what I do in the Senate and I did in the House is, how do we rebuild American manufacturing? I don't think we are a global power in terms of national security or in terms of domestic security for our families unless we make more things. I see what happens to families in my hometown of Mansfield, Ohio, when they see the kind of wage drop that they've seen when a plant closes and they're making $19 an hour, and now they're making $12 an hour if they have jobs and they're 40 and 50 years old. And the answer is, well, more highly skilled workers go to community colleges, all that. I hear that assertion is always made by people that dress like this and make policy, whether they're economists or politicians, far too often. But second, and a more practical, to speak to the people that hate that statement, is we're subsidizing. I mean, we know what we're doing to subsidize financial services. I mean, strip away all the bright kids from Princeton that go to Wall Street and don't come back and work in their father's company or their mother's company, or just come back and want to be entrepreneurs and make things, and strip away trade policy that does incent, I think it's a verb, I'm not sure, incent companies to go overseas. And I'll give you one example about where we miss on innovation. It's a very simple example. It happened I was in Minster, Ohio, right near where Neil Armstrong grew up in Wapakoneta. And it's the largest yogurt manufacturer in North America. It's a Dannon yogurt plant. And I went in there and I was I love going to factories because I like seeing things made, and I know that's still the future of my state as it is the country in many ways. And for years, they had bought their little plastic cups from a supplier they were brought in, and they squirted the yogurt out of these. They took the yogurt out of these big vats, the fermenting milk, and squirted them into these plastic cups and sealed the cups on the line. And a young industrial engineer that looked to be about 12 to me, with a couple of line workers, said, "This is stupid, we can do this better." And they developed a machine, not even from here to the other end of the room, probably about from here to the other end of the room, where they bring in rolls of plastic, feed the plastic into, and heat it, extrude it, cool it, fill it with yogurt in one move. And that's where innovation takes place in the factory floor. And when we continue to have policies that cause us, for a variety of reasons, to do the innovation in this country and then move the manufacturing overseas, we lose our innovation edge. And we can talk economic policy, and I think economic policy, whether it's taught in college or talked about on the Hill, can work in a way that helps American manufacturing. And I don't think it's showing a bias. Larry Summers was in my office one day, and I was talking to him about that. And he said, well, we don't pick winners and losers, because I was talking to him about industrial, about manufacturing. He said, we don't pick winners and losers. And I said, well, our country really has picked financial services a winner in a whole host of policies for the last 25 years. I'm not asking you to pick solar over wind. I'm asking you to look at manufacturing and being a country that makes something.